Greetings, everyone, and thank you for joining us on today's live webinar discussing current conditions and some of the changes that we can anticipate coming as a consequence of the recent presidential election. So first of all, just a highlight of some of the things we're going to cover. We're going to touch very briefly on what happened in the markets in 2016. We're then going to move on to 3 U.S. factors that we believe are going to drive change in the coming year and beyond. We're going to then move on to 3 global factors that should do the same thing, 3 economic variables to watch, and then finally we're going to be talking about the strategic profile you should take to manage the changes that are coming and also to be prepared to manage some of the uncertainty. So our San Francisco office was at a Financial Planning Association meeting a week ago in which Joachim Fels, who's an economist with PIMCO, was giving a presentation, and he opened his presentation with this quote. And I think it's particularly relevant. This notion that inviting an economist to address you at the beginning of every year means you are either optimists or masochists. And of course what he was referring to is the fact that economists, dealing as they do with this incredibly complex and chaotic phenomenon, this complex and chaotic network of relationships that we call the economy, whether we're talking about the U.S. economy or the global economy, is so complex and chaotic that it really defies prediction. Anytime you hear an economist propose a model for the relationships between variable A and variable B, suggesting that a given change in A will result in the following change in B, they always close with the Latin phrase ceteris paribus, which means all other things being equal. And what they're referring to is the fact that any 2 variables in the economy that may have a relationship also have hundreds or thousands of other variables impinging on them at the same time. Now, if you could hold all those other variables constant, then this identified relationship would likely emerge. But you can never hold all other things constant. And as a consequence, it's been well established that economists do a terrible job of predicting what's going to happen in the economy. And it's for the same reason that meteorologists do generally a terrible job of predicting tomorrow's weather or next week or next month's weather, because they too are dealing with complex, chaotic systems. Now, economists are really good at explaining why something happened retrospectively, because they can look back and see which conditions were in effect at the time. So this rather long-winded introduction is by way of saying you have already, and in the coming weeks and months, will read many, many more predictions from economists. You'll see it on television, you'll see it in the newspaper, in the magazines, and all such predictions should be taken with a grain of salt. And I think you're going to find that here today, I'm going to try and identify things that are identifiable. We're going to try to minimize as much as possible the exercise of prediction or crystal ball gazing. But nonetheless, hopefully, at the end, we'll have some strategic profiles that you can adopt that will help you weather whatever changes may be coming down the line. So let's talk about the market in 2016. Now, this represents the Dow Jones Industrials, but in general, broad behavior, it's also reflective of pretty much all stock markets around the world last year. And as you may or may not recall, the year started out pretty scary. We were doing a lot of writing at the time about how to think about this rather dramatic plunge in the U.S. and world markets. Of course, the year ended rather differently and rather dramatically, such that overall most market measures, all stock market measures, and most diversified portfolios were up significantly. In most cases, in the case of our portfolios, generally well into the double digits for last year. Not in any small part as a consequence of what happened at the end. Now, of course, the interesting thing is, even if you had known in advance what the election results were going to be, you'd have gotten the market wrong. And that was actually the early reaction was that the results of the presidential election were going to be a bad thing. I can recall probably sometime around 1 a.m. Watching the election results, and of course it had become, by that time, 1 a.m. Pacific time, it had become obvious what the outcome was, and seeing reports at that time that the Dow futures contracts had plunged over 800 points. So the initial sort of pre-opening reaction of the markets was quite dramatic. By the time markets actually opened that morning, that reaction had disappeared, and of course you can see here what happened through the balance of the year. So there was a dramatic shift in sentiment, and I will be talking more about the notion of sentiment and what John Maynard Keynes called animal spirits later, because these things will will have an effect on your experience, both with respect to the economy and the markets. With a little broader look, maybe I should say a little more detailed look at what happened last year, you can see that pretty much all of the biggest action were in small company stocks. This is one of those examples when small company stocks and even large company value stocks behave differently than the rest of the market. You know, the Vanguard 500 index, which has been pretty dominant in recent years, was left in the dust by domestic small and small value stocks, and even by domestic large value stocks, and for that matter, by emerging markets. So it was an interesting reversal. A lot of the market segments that had been lagging what you might call blue chips or growth stocks suddenly came into their own. And this was, no doubt in part because of the shift in sentiment we've been talking about with respect to what the business environment was going to look like going forward into 2017 and beyond. So now let's talk about the three major factors that are going to be driving visible changes in the coming year. One is, maybe the most obvious one is we're going to have a new presidential administration that's not going to look very much like the last one, which is to say not going to look very much like the policies that we've seen coming out of the White House over the last 8 years. And that's going to have implications for the economy, the markets, and your finances. Republicans held on to both the Senate and the House. And as a consequence, they now have both Congress and the White House. And it means that there are going to be policy initiatives that were not possible before that are going to be not just possible, but very probable going forward and in the very near future. And finally, Federal Reserve policy is going to continue to be relevant as it evolves in a more normalizing, what they're calling the direction of normalization. And there are also some implications for the markets that are beyond the Fed's control, and we'll talk a little bit about that. So with respect to those three drivers, how are changes going to be arriving? Well, first of all, we're going to see public policy changes. And they'll take the form of tax legislation. That's almost assured that there are going to be changes in the tax laws, both income tax, estate tax. These are things that there are well-established proposals out there, and we'll discuss in detail in a moment what those proposals look like and what the most likely form of legislation is going to look like, and again, the implications for you. Fiscal policy, there's some proposals from the incoming administration that maybe not right away, but have a good chance of getting a more sympathetic hearing in Congress than the prior administration did with its fiscal policy proposals. And then there's going to be trade policy. Of course, this is a very controversial one because trade policy has the potential to have an enormous impact, not just on the U.S. economy and U.S. businesses, but on businesses and economies all over the world. Sentiment and animal spirits. A lot of what happens in the short run is driven by sort of almost, I'm going to say, gut level beliefs of investors and consumers for that matter. Animal spirits is a phrase that was coined by the very famous economist John Maynard Keynes. And what Keynes was referring to is that in his context, he was referring primarily to the investment decisions of business owners. The demand in the economy is driven by three sources: consumer demand for goods and services, which is the single largest form of demand; government demand, which is the second largest, and then business demand or business investment. And that can be investment in plants and infrastructure. It can be inventory investments. But of the three, business investment is the most volatile and is so unpredictable that Keynes proposed that business owners don't really do a detailed, as a group anyway, don't do a detailed analysis of 1 + 2 + 3 equals a given change. They tend to do an analysis based on gut feeling and what he called animal spirits. And so this is one of the things that we're going to see more of, I think, in the coming months for reasons that we'll discuss momentarily. And finally, another channel for change to manifest is going to be perhaps Twitter. This has become a very interesting channel, one that has come to dominate the news cycle. As you can see, just yesterday, President-elect Trump made some comments via Twitter about the dollar being too expensive, and as a consequence, the value of the dollar fell. I actually read an article yesterday, the day before, pardon me, saying that a very prominent currency trading company, which had previously banned the use of Twitter on their trading floors, had actually given their traders permission to start monitoring, pardon me, to start monitoring Twitter, because suddenly it had emerged as a channel for information, if you will. But I'm going to say noise. When we talk about what happens to the markets, whether you're talking about the currency markets, the bond market, the stock market, on a day-to-day basis, they follow a fairly random path. It's called a random walk. They it's kind of like a drunk, if you think of it. The markets stagger up and stagger down with generally no discernible pattern in the short run. And the reason for that is that the market makers and investors are trying to incorporate and interpret the daily news that rolls in minute by minute throughout the trading day. And then they push prices up or down depending on whether or not they think the news that just emerged is positive or negative. But in a very real sense, and especially if you have a long time horizon and a long-term perspective, then the news that rolls in every day is just noise. It's just noise. Whatever news rolled in today and pushed markets up or down, the opposite news is going to roll in tomorrow and have the opposite effect. So in the short run, news is just noise, and it doesn't really convey information about what's going on deep down in the economy that the markets are trying to reflect. And generally, we're trying to harness with the sort of the deep phenomenon, the fundamental goodness, if you will, going on deep below the surface rather than the random noise. Well, all of a sudden, the noise has gotten noisier. All of a sudden now we've got 140-character tweets that can swing markets on a daily basis. And you see it in the headlines. I mean, I actually captured these headlines literally from just like the last couple of days in the newspaper. And you can see that President-elect Trump's tweets in some cases are playing havoc with individual stocks in the stock market, to the degree that you can now get an app that will notify you if the President-elect is tweeting about a company you care about. So this is one thing that's going to drive more volatility in the short run. And it's something that we think that any good investor should ignore just as much as you would ignore any other daily noise, maybe even more so, because we don't think that these convey real information. We don't think they convey real information about what's going on deep down in the economy, down at the core where the real economy is chugging away. And we don't even think it really conveys important information about policy direction in the future. There seems to be a random character to this tweeting. And so this is one more thing that we think you should ignore. Interestingly, as an avid consumer of newspapers, the Wall Street Journal, the New York Times, the Economist magazine, and others, I've noted that again and again in recent days and weeks, the editorial staff of these newspapers is suggesting that they are going to stop following the tweets. They're going to start ignoring those and trying to report only real policy decisions as they emerge. Now, you know, these intentions that they've been forming haven't worked out too well as far as I can see, but I wish them luck. I hope they can get to a place where they're reporting real policy and not 140-character noise. So what should we focus on instead? So this is just like laying the groundwork for how to think about some of the things that we're going to talk about in the coming minutes. In laying the groundwork, I think we need to think about that deep goodness I was talking about. You know, when you think about the economy, many of you have heard me say this before, you know, the economy is not a big machine, notwithstanding the fact that it gets reported with numbers and statistics. The economy is you and me and everyone we know going about the business of earning, saving, spending, and investing. And those individual decisions that we each make to try and make our lives better and try and improve the lives of our families aggregate up to this thing we call the economy. And individuals, in addition to being growth-seeking, they are resilient, and they do adapt to whatever the changing circumstances are that they're faced with. And that's why economies, they hit bumps in the road. We occasionally have a recession. The markets occasionally, you know, we have bear markets that occur occasionally, sometimes even crashes like we had in the Great Recession. But nonetheless, they ultimately recover. And it's because of this fundamental propensity for individuals to be resilient and ingenious and growth-seeking, and that individual propensity, those individual propensities aggregate up to resilience and growth, and a growth bias on the part of the economy and the markets. And so we have to start, I think, with an understanding of that fundamental goodness. It's because it's just too easy to be hypnotized by the surface volatility and the surface noise. So if the stock market represents the ownership of the productive assets of the economy, and the economy is fundamentally growth-oriented and resilient, then we have to have some faith that harnessing ourselves, hitching our wagon, if you will, to those fundamental factors are the things that are going to benefit us most in the long run. And that's, of course, what we're all seeking. If you try and be a short-term investor, if you try and trade against the daily volatility, you will lose every time. There are people out there, there are flash boys out there, there are high-frequency traders who will eat your lunch. But if you harness your investment decisions and your other financial decisions to the deep long-term trends, you hold a much greater probability of achieving your goals and surviving all of the choppiness of the noise. And of course, at the end of the day, we must all remember to breathe. And I will tell you that I've been doing a lot more of that in recent months, and I highly recommend it to anyone else. A little mindfulness, a little breathing goes a long way. And for that matter, taking a break from many of the news programs, you know, Elise and I decided when we finally got to the end of the election cycle, which for anyone who was following it closely was quite painful all the way around, we swore that we were going to take a fast from CNN, and essentially have not tuned into CNN once since November 9th. And I think that's probably going to continue for a while. I will confess that we do at least once or twice a week watch the News Hour on PBS, which seems to be a little easier to take. They're not so much showbiz oriented as most of the others, including CNN. But I recommend that. Take a break. Whatever your practice is, whether it's yoga or taking a run or getting on the treadmill or the elliptical or just sitting down and breathing, I think we could all benefit from some of that. It just helps give us that broader frame within which we can harness those long-term forces that we want to harness. All right, so now let's get down to nuts and bolts. When we think about coming tax legislation, since the Republicans are now in control of both Congress and the White House, we know there's going to, and both the White House or the incoming administration and especially House Republicans have expressed desires for tax change. We can assume there's going to be tax change because there's little to stop them. So the key is to look for the overlaps. It's like a Venn diagram. The degree to which the Trump plans and the House GOP plans overlap, I think that's where we can assume or assign a high probability of that happening. The first thing you'll note in that first line here is that both both the White House, the incoming White House, the incoming administration, and the House Republicans are proposing to reduce the number of tax brackets from the current 7 down to 3. And in fact, it's the same 3. They're proposing brackets of 12%, 25%, and 33% for earned income. And so that what that means is that anyone who is currently in a tax bracket higher than 33% is seeing a significant tax break, because the 33% tax bracket starts in pretty much the same, at least under these proposals, nothing's been enacted yet, starts in pretty much the same place it does now, but instead of going up, it just flattens out at 33%. So that's a significant tax break for those with very high incomes. When you look at capital gains and dividends, what you'll see is that, again, there are preferential rates under the two plans, although they're different. The Trump plan suggests that if you're in the 12% bracket for ordinary income, you pay 0% for capital gains and dividends. If you're in the subject to the 25% bracket for ordinary income, for earned income, then you would be subject to a 15% rate for your capital gains and a 20% rate for capital gains if you're in the 33% bracket. The approach that the House Republicans take, rather than specifying rates per se, is they say that half of any of your capital gains and dividends would be excluded. So if you're only reporting half of your capital gains and dividends, effectively the tax rate for those is half of what the ordinary income rate is, or in this case, 6%, 12.5%, and 16.5%. Now the standard deductions that both are proposing are going to be higher. Not that many people itemize their deductions now. Far fewer will if these higher standard deductions are enacted. And as far as itemized deductions are concerned, the proposals are quite different in many ways. The incoming Trump administration is proposing not to change any of the categories that are currently deductible, but to put caps. So the amount of itemized deductions you could take would be capped at $100,000 a year if you're an individual filer, and $200,000 a year if you're filing a joint return. The House Republican proposal would be to do away with the deductibility of all other items except for mortgage interest and charitable deductions. So that would be that could be significant. For example, the ability to deduct state income taxes would be gone. So this is a difference that we don't know how this is going to be resolved between the incoming administration and House Republicans. Obviously, it's going to be resolved in some way, and I think we can take for granted that there's going to be some change, some type of change, whether it's going to be a blend of these two or one is going to dominate. There will be some change in the itemized deductions. Pardon me. Both the incoming administration and the House Republicans are proposing to repeal the alternative minimum tax. They're both proposing to lower corporate tax rates from the current 30% to either 15 or 20. And they're both proposing to repeal the estate tax. Now, right now, very few people are subject to estate tax because individuals can exempt up to almost $5.5 million worth of property, which means a married couple could exempt between them almost $11 million worth of property, and that means that the vast majority of Americans are not going to be subject to estate tax. So this repeal of the estate tax potentially benefits much larger estates, although there are some wrinkles, because when you repeal the estate tax, what you're left with is capital gains taxes. Now, in the case of the incoming Trump administration, they're proposing to give you a step up in cost basis. The way that works, if you own capital assets like stocks or bonds or a home or other real estate, if you go to sell it now, you have to pay capital gains taxes on the difference between what you paid for it and what you sell it for. Currently, under current estate laws, when you die, all of your property gets a step up in cost basis. So it gets the cost basis gets stepped up to current value if your heirs or beneficiaries were subsequently to turn around and sell that property, whether it's mutual fund shares or stocks or real estate, they would owe no capital gains taxes. So if you do away with estate taxes, all of a sudden capital gains taxes come back into play. The Trump administration is proposing to provide a step up in cost basis for up to $10 million, and anything above that will be subject to capital gains taxes. And the House GOP plan proposes to repeal, and they are, at least at the moment, silent on what they would do with respect to exempting any amount or giving a step up in basis to any amount. For most people, this will not be an issue. For some of you, it may be, and that's one of the things that you need to plan for, and that we intend to be planning for as it emerges. This is one of the things I'll talk about more, is that with many of these things, there are implications that can lead to action in the moment, but a lot of the implications we have to take a wait-and-see attitude. So now let's talk about Social Security. And I know Social Security and Medicare are two of the programs that have a lot of people worried. Let me start with some background. So currently, the Social Security Administration, in the last, the trustees' last report, they were projecting that sometime in the mid-2030s, sometime around 2034, so a little less than 20 years from now, the trust fund would run out of money. Now, when that happens, it doesn't mean that the Social Security system is bankrupted. It doesn't mean that people's benefits stop, but it does mean that they're potentially reduced. So under current projections, if nothing else were to happen, sometime in plus or minus 20 years from now, Social Security benefits would potentially be reduced by about 20%. Now, this is not the first time this happened. Back in 1983, we're talking about something that's almost 20 years in the future. Back in 1983, we actually got to a point where the trust fund was literally within months of running out of money. And Congress put together a commission that came up with a fix. And the fix was to increase the full retirement age, the age at which you qualified for a full benefit, from 65, which it had been since the program was put into place in the 30s. It would slowly increase it from 65 to 67. Didn't affect anyone who was on the cusp of retiring. And in fact, to give you an idea of how slowly that was actually implemented, we don't reach the full age 67 as full retirement age until 2023, or at least for those who are turning 62 in 2023, those people will have a full retirement age of 67. Others retiring between now and then, it'll be 66 in some months, and it goes up by a few months every year. So that's the current environment. Representative Sam Johnson, who's chairman of the House Ways and Means Committee, has made the following proposal and actually drafted legislation. And this is taken by most people as being probably the broad outlines of any plan that would get a lot of House support going forward. And I should mention that President-elect Trump has not been all that supportive of any changes to either Social Security or Medicare. It's not to say that he or his administration will change its mind, but right now, that's the way it stands. So at least while he was campaigning, he was suggesting that those should be left alone. But if something does go forward, Representative Johnson's plan is the one that probably represents the key outlines. And what he proposes is that for those people turning 62 in 2023 and those who follow them, that the full retirement age will increase by 3 months a year, every year, until it has moved up from 67 to 69 in the year 2030. So, first of all, any of you who are already on Social Security or about to go on Social Security in the next few years, as you can see, even this proposal would have no effect on you. The age of mandatory withdrawals, the age when the required minimum distributions kick in, it would move from 70 to 72, and it would do so on the same schedule over that same time span. You could take benefits sooner, but you would be allowed to extend benefits later and get the increase. The cost of living adjustment would be less generous. The proposal would incorporate what's known as the chained CPI, which tends to produce smaller increases than the consumer price index as it's currently used. The all-urban consumer price index tends to generate higher increases in a given year than the change. So for everyone, the cost of living increases would be smaller, and there would actually be means testing. And for those with adjusted gross incomes above a certain threshold, you would actually get no cost of living increase at all. So that's where that stands right now. And it's hard to assign probabilities, but the likelihood is that there will be some change. So by the way, I see that some of you have your hand up to ask a question. And the way to do that is to type your question into the chat box on your GoToWebinar control panel. So look for the chat box. You may have to expand it and type your question in there, and then we'll do one of two things. If it's a clarifying question about something I'm talking about right now, I'll address it in a moment. And if it's a broader question, some of those we'll save to the end. So let's now move on to Medicare. So what House Republicans are proposing is what they call premium support. And this is something that House Speaker Ryan has been talking about and proposing actually quite a few years now. A lot of people refer to this as a voucher plan. The fundamental form it takes is to provide the equivalent of a voucher, the equivalent of a certain amount of premium support that individuals would then use to buy private insurance. The rationale is that it would foster more competition in the private insurance market for those who are over age 65, and premiums would come down, benefits would improve. To put it mildly, there's a diversity of opinion about whether or not these kinds of medical services are actually best controlled in a free market environment. There's some reason to believe that there would be some downside. I mean, one of the things, and I should mention that the current Medicare fee-for-service that exists, the proposals vary somewhat, but generally suggest that either that would continue to be an option, and essentially it would be like the public option. It would be in competition with the private insurance companies. And I should say that the private insurance companies complain that it would be unfair because the Social Security Administration would be setting the standards that they had to hew to, and would also be competing according to the standards that it set. And there's some suggestion that it would be unfair to have one entity both set the standards and compete according to those standards. But there's some proposals in which some people will be grandfathered, and new, sort of new participants would not even have that choice. I should mention that currently over a third of the 57 million people on Medicare already are, in a sense, using a private option in the form of Medicare Advantage plans. Kaiser and a number of other carriers have these Medicare Advantage plans, in which the Social Security Administration pays them directly, and they handle all of the services. They manage all the services in exchange for payment from the SSA. Now, these plans are more expensive, and they actually cost 2% more than the fee-for-service provided by Medicare. So Medicare is actually subsidizing the third of the Medicare population which is using these, and partly as a consequence of that, there's some fear that if everyone was forced into private plans, they would in fact, as are the Medicare Advantage plans now, they would in fact be more expensive, and therefore the premium support would be insufficient. People would be paying more out of their own pocket, and that there's further fear that premium support would not be increased every year sufficiently to keep up with medical inflation. So those are all concerns. However, the thing I will say is that it's very clear that at least right now very little Senate support for getting into any changes to Medicare. I'm not going to say it's quite necessarily the third rail that it's always been, but it still looks pretty hazardous to a lot, especially in the Senate. And President-elect Trump himself has said that Congress deciding to pursue changes in Medicare is like having a death wish. So it strikes us that changes in Medicare are much less likely than changes in Social Security, and even changes in Social Security may prove unworkable. I think that the key takeaway for you with respect to Social Security is that if there are changes, it won't affect you if you're receiving Social Security or anywhere near receiving Social Security, and we think changes to Medicare are possible but not highly likely in the foreseeable future. So now let's talk briefly about the stimulus proposals. So we've already talked about lowering of tax rates, and I should just mention that with respect to stimulating the economy, lower tax rates themselves are considered stimulatory. So that's one factor that would already be in place to stimulate, at least potentially stimulate additional economic growth. Beyond that, there have been proposals for extensive infrastructure spending. In many cases, spending, the proposals have been to spend up to $1 trillion. And of course, we're at a point now where the economy is much closer to its full capacity than it was 4 years ago, 5, 6 years ago, in the aftermath of the Great Recession. The infrastructure spending, in many cases, it's necessary. Everyone, I think knows well, if you've been reading the newspaper or any other source, that the U.S. has a crumbling infrastructure. We have bridges and roadways and airports that are sorely in need of new investment. And so it's important from the standpoint of raising the productivity of the economy. When you invest in infrastructure projects, it ultimately raises the potential growth rate of the economy, so it's good from that standpoint. There's some question about how good it would be for stimulating additional economic growth in the short run when the economy is at this sort of later stage of economic recovery. And in fact, it may very well stimulate a faster rise in inflation, something we'll talk about more in a minute. It's unclear what form this would take. Some proposals are for more government direct spending. Other proposals are for financing this through the private sector by offering tax credit. And of course, tax credits for projects like bridges or toll roads where private contractors, private entities can build out infrastructure for which they can then receive a revenue. I mean, those are the kinds of projects that work best with tax credits. They tend to be somewhat regressive in that they hit those with lower incomes harder than those with higher incomes, because everybody has to pay for it, if you will. But that'll be it's unclear which form it's going to take, and it's even unclear whether or not this is going to come through. I mean, one of the things that has been clear when you listen to congressional leaders is that they're all pretty much across the board. Republican congressional leaders are saying it's highly unlikely that they would take up any such proposals in the first 100 days. So they're paying lip service and saying, oh, we would give a sympathetic ear to anything the administration proposed, but they're suggesting that it would be later this year or maybe even later than that before they would take this up. So it's something that we don't think is going to have a big impact in the near future, but it's something, again, it's like everything else, it's something to keep an eye on. It is also something that if it did happen, and it did happen in a big way, and it did prove to be inflationary, because at some point you start to compete for resources with the private sector, and that can drive up interest rates, drive up inflation rates. But that could prompt the Federal Reserve to accelerate its rate rise policy, which could, interestingly, actually offset any stimulative impact of the project itself. So the impact on economic growth is very much up in the air at this point when it comes to infrastructure spending. So now let's move on to a review of the global factors that are going to drive change. One of them is a rise in populism. This is something that we've obviously seen in the U.S. The Trump campaign ran a very populist campaign that emphasized domestic issues over international. It was anti-globalization, anti-trade. It was it was very sort of insular and inward-looking. And this is something that we're seeing now, and also anti-immigration. These things are all obvious and well-established. I'm not taking, obviously, political positions in saying that. We're seeing the same things elsewhere. The Brexit vote in the UK was also very much driven by a rise in populism, anti-immigration, anti-multilateralism, anti-globalization sentiments that were building there. These forces are building in France and Germany. Marine Le Pen is her support in a very far-right populist party is growing rapidly, and Angela Merkel in Germany likewise is going to be facing challenges from the very populist right-wing parties there. So this is something that's a wild card. It could cause, if these populist movements get control in France and Germany and the Netherlands, where there's also similar moves, it could cause further fracturing in the European Union, and that could create dislocations that are felt everywhere. Brexit itself, which again was a manifestation of this, is going to have unfolding implications. The thing about Brexit is, in the immediate aftermath of the vote, markets took a brief hiatus, a brief hit, if you will, and then they rapidly recovered. And the UK market's much higher. The UK economy did not see an immediate negative impact. Partly that was due to positive sentiment that buoyed the markets and the economy. But the longer-term prognosis by most economists is that this is going to have a negative impact on the UK, which has benefited so much from being one of the financial centers of the world, and certainly the financial center of the European Union. And so, by the way, there was a question about this PowerPoint being available later, and it will be available. It's going to be recorded. The recording will be available later on our website, and the PowerPoint slides will be available later on our website. So if you're taking notes, don't worry, you'll have access to all of this. So back to Brexit. There is a belief by the majority of economists that ultimately it's going to have a negative impact on the UK economy. And the UK is the 5th largest economy in the world, which is not a trivial thing. And so this is something also to watch and see. Again, human beings are ingenious and resilient, and we'll see how well they navigate these kinds of changes, whether or not the UK is able to negotiate favorable terms in its separation from the European Union. The early signals are that it's going to struggle to do that, but but this will be one to watch. But it's probably in the long run a net negative, and we'll just have to see how big a net negative. So the third and final are threats to international trade. And of course, this begins in the U.S. because this is where the incoming Trump administration has been the most vocal in terms of, well, it's been very vocal in terms of being anti-globalization, anti-immigrant, against very sort of insular and inward-looking. Other parties, as we mentioned, other parties in France and Germany and in the Netherlands have taken a similar line, but they're not in control. And the incoming Trump administration obviously is going to be, is going to be at the helm. And so the rhetoric about trade coming from the incoming administration is relevant, because the U.S. and the rest of the world depend heavily on trade. And if trade barriers are erected, if there's proposals from Congress to change tax policies to favor exports and disfavor imports, which would likely create, on the one hand, it could create incentive to onshore more jobs, although the onshoring of jobs is a little bit of a misnomer, because the reality is there's been a huge growth in manufacturing in the U.S. already. U.S. economy, the share of the U.S. economy in terms of gross domestic product represented by manufacturing is pretty much as large as it's ever been. The difference isn't manufacturing share of the U.S. economy's output, it's manufacturing share of employment. Employment in manufacturing has been shrinking in large measure because of efficiencies and automation. So it's not that we're no longer a manufacturing nation, it's just that we're no longer a nation that generates a lot of jobs manufacturing. And so that's the other reason why some of these policies look like they would be wrong-headed. And so the incoming Trump administration has even talked about renegotiating existing treaties like the NAFTA, the North American Free Trade Association between the U.S., Canada, and Mexico. And these things would probably be a net negative and might very well lead to retaliation by other parties. With the Smoot-Hawley Act back in the 1930s is one of the things, or the late 20s, is one of the things that led to the Great Depression. There was a complete collapse in international trade. Now, we're not predicting anything like that. We're much more optimistic that there's going to be a certain amount of inertia, and it's going to be hard to change the current global order. It's very easy to mobilize support among the population by having some pretty fiery rhetoric. But actually changing these things is a little harder. You can jawbone it, you can tweet about it, but actually making fundamental structural changes is not going to come overnight, and it's not going to be easy. So we tend to be a little bit on the optimistic side that there are not going to be radical changes to the current trade regime. But if there were, it would definitely be a negative. So now let's talk about three economic variables that we think bear watching. Inflation. The 5-year forward-looking inflation expectations as tracked by the Federal Reserve and reported by the St. Louis Fed has been rising. And you can see just over the last year, it's risen to over 2%. And in fact, the consumer price index has been rising. The last measure I saw from a month ago, I think it was up to 1.7%. It's expected to hit 2%. Now, the Fed has talked about the fact that it wants inflation to rise to the 2% level. Now, the Fed, when they talk about that, they're talking about what's called core inflation, which is a different measure than the consumer price index. And so that probably translates into something more like 2.5% with the consumer price index. But it's very important to understand why the Fed actually wants some inflation. Those of us who lived through the 70s and early 80s, where we saw a stagflation, when there was little or no growth in the economy, and yet prices were rising. At one point, prices were rising at double-digit rates. That was all pretty bad. And so, those of us who maybe carry a few scars from those years think of inflation, can easily think of inflation as always bad. But a little bit of inflation is a good thing. I'll talk about that a little bit more, but there are reasons to favor a little bit of inflation to sort of grease the works and create some consumer demand. So it's actually good that inflation is rising right now. We're a long ways from becoming a problem from an economic standpoint. Interest rates. So currently interest rates are also rising, partly because of Federal Reserve policy and partly because of markets. And I will talk in more detail about that momentarily. And finally, economic growth rates. At some point, you have to have growth. You have to have, if the economy is growing, that supports higher corporate profits, higher wage earnings, and typically it's growing because consumers are buying more, businesses are producing more, investing more, hiring more people. So, the rate of economic growth underpins everything. And so this is something that we watch very carefully. And again, we'll talk more about that in a moment. So let's talk about Federal Reserve policies. So the Fed has, in their last, a month ago, in their last policy guidance, the forward-looking policy guidance, the Fed is trying to be more transparent than they once were. They suggested there would be 3 more rate hikes. There would be 3 rate hikes in 2017, maybe more, but I think they said 2 to 4, but so everyone's settling on interpreting that as 3. Now, of course, they said the same thing a year ago, and we didn't, and they failed to fall through because of dislocations in international markets and some economic bumps along the way. So they're going to continue to be pragmatic. We'll see if we get more increases. We actually expect them to probably be more aggressive. I will say that I actually had dinner last night with someone who works for the Federal Reserve Bank of San Francisco, and he was very, very insistent. We were talking about interest rates. And with respect to anything the Fed controls, it's going to be very slow and very measured. That's the Fed's. That's what they're communicating, and that is in fact the stance that they want to take. So they want to be consistent, but they're going to move slowly. Future moves, whether they're 2 or 3 or 4 in the coming year, are likely to be in the 1/4 point increase that we've seen in the last couple. 1/4 point in the Fed funds rate. But it's important also to remember, no matter how measured the Fed is, they only directly control short-term interest rates. The Fed funds rate is their favorite short-term vehicle. That's the rate at which banks lend excess reserves to each other, and so they only control those, other than when the long-term interest rates are set in the bond market, longer-term bond market, by buyers and sellers of bonds. Now, sometimes the Fed chooses to be a big player in the bond market and buy and sell bonds to a significant degree, and like they did during quantitative easing. But unless they're doing that, it's bond investors who are the ones who are setting interest rates. And one of the things we've seen that investors have done in the latter half of last year was they moved the 10-year Treasury yield from 1.4% to 2.4%. Whether or not that's a harbinger of things to come, it's hard to say. But with inflation rates moving up and interest rates moving up, there's some implications that we'll talk about more in a minute. Economic growth. Well, the latest measure we have is the 3rd quarter of last year. Growth ticked up to 3.5%. It's been averaging around 2%, with a lot of variation, as you can see. President-elect Trump has talked about ginning up the economy to 4% growth rates. That's really highly unlikely, especially with a mature economy like the U.S. The couple of key factors that drive that are population growth and the growth in productivity, output per hour worked. And productivity is kind of stuck right now around 1%. Population is growing a lot less than 3%. And so it's hard to see where you get a foundation under any kind of consistent 4% growth. We're more likely, most economists are predicting something more likely in the range at best of around 2.5%. And that may be the new normal for the U.S. economy. So now let's move on to strategic positioning for some of these factors. So first of all, I want to open with a proposition, and it's not new. I'm sure you've all heard this before, that presidents, they just have less impact on the economy than they're generally credited with. That, as the old saying goes, they deserve less credit when things are going well and less blame when things are going badly. Even though, when things are going badly, they're happy to support this proposition, but when things are going well, the president is always going to take credit. But the reality is, the president has limited impact. The exceptions being during extreme events like the Great Recession, when they can step in with extraordinary policy prescriptions. The case in point, when the Great Recession hit at the end of George W. Bush's administration, the actions that he took and his Treasury Secretary Hank Paulson and Ben Bernanke, the chair of the Federal Reserve, which were then picked up and carried on by Barack Obama and his Treasury Secretary Timothy Geithner, they took extraordinary measures which probably kept us from going into another Great Depression. I think we were truly fortunate to have Ben Bernanke, one of the great scholars of the Great Depression, heading the Federal Reserve at that time. But except for extreme moments like that, presidents sort of in the ordinary state of affairs have minimal impact. So now let's talk about public policy changes where they do have an impact, especially if they have the same parties in Congress and the White House. So the reality is that we know what's been proposed, and we actually took some actions late last year in reaction to the most likely outcome. But in most cases, watchful waiting is really what's called for. And then developing strategies in real time as real policies actually emerge and are adopted. The one thing that we will say is you should not make any irrevocable moves that are purely tax-driven. Do not make investments where tax allowances or tax deductions are going to, especially over a period of years, are going to be a key part of that because the tax laws may change in ways that take that away from you. So be very cautious about making any moves, whether they're investment moves or others, that are driven to a significant degree by tax strategies. And continue to, the general trend in tax changes based on all the proposals coming from the Republicans is for lower tax rates in general. And so you're going to want to continue to defer income into some future point where those lower tax rates emerge and accelerate deductions into the present when tax rates may remain higher until if and when new laws are actually adopted. So keep that stance. Until you actually see those new laws in place, continue to defer income where you can, the realization gains where you can, and accelerate deductions into the present. With respect to trade policies, as I mentioned earlier, we're hoping there aren't going to be big changes, but to the degree there are, they're going to impact countries and regions and exchange rates differently. And so this is the ultimate place where you really need to be broadly diversified. You need to diversify across countries and regions. You need to diversify across industries. And you need to diversify your currency exposure. Now, we happen to do that. Half of our stock portfolios are outside the U.S., and they're actually invested in held in non-U.S. terms. So, to the degree we're exposed to what is now kind of an expensive dollar, if the dollar slides, as it did actually in recent days because President-elect Trump was sort of talking it down, that actually benefits half our portfolio because the returns from the non-U.S. half of the portfolio get juiced up. So it's good to be diversified in a currency fashion as well. With respect to monetary policy and interest rates, so the rising rates are going to continue. Whether or not the Fed hits its target of 3 increases, but the chances are good that it's going to continue in the markets, that bond investors, especially if they see a continuing uptick in inflation, they're going to be demanding higher interest rates. And so you're going to see rising interest rates and falling bond prices. In order to protect yourself and your investments, you're going to want to focus on short to intermediate maturity bonds, not get long, not stretch to longer maturities in order to capture higher yields. You're going to increase the chance of getting hurt as rates rise. And you're going to want to be globally diversified because we have a diverse interest rate regime going on in the U.S. and outside the U.S. With respect to intermediate maturities, even if they take a little bit of a hit with rising rates, eventually those bonds within that portfolio will mature at par, so you get that back, and also the reinvestment rate goes up. So as bonds mature, those funds get reinvested at now higher yields. So intermediate and even longer term portfolios can absorb over the long run rising rates, but if you're in a position where you have to spend from your portfolio, you can't afford to absorb that, because if you take a hit and then you sell it, you never make it back. So again, especially if you're spending from your portfolio, you need to stay on the shorter end of the spectrum. With respect to inflation and interest rates, as I mentioned earlier, higher inflation within limits can be good for corporate profits. It gives companies pricing power. That could be good for the stock market and could actually build a further floor under the U.S. market and markets abroad. Higher inflation within limits is good for the economy as a whole, and encourages consumption. One of the reasons that they worry about deflation is that if prices aren't going up or if they're actually going down, nobody goes out and buys anything. Why would you buy something if you could get it cheaper in 6 months? And so a little bit of inflation actually encourages consumption and actually gins up economic growth. And finally, rising interest rates, if that trend is going to continue, and we think there's reason to believe it will, it might mean that it's time to buy and or refi if you've been on the fence about buying a house or about refinancing. This is the time to take a hard look at pulling the trigger, because it's not likely to get better going forward. So finally, in conclusion, we think it's important to sit with the fact that presidents have less impact, especially in the short run, on the economy than sort of the broad swath of humanity going about the business of earning, saving, spending, and investing. They can still set the tone for sentiment and animal spirits in the short run, including with an active Twitter account. And so that does raise the potential for higher volatility. which is going to make it maybe a little harder to stay the course, but doubly important to do so. We think it's important to think in terms of harnessing those deep regularities, and not focus on the noise, not focus on what somebody's tweeting on a given day, and frankly, not even focus on the daily news, on CNN, or what the newspaper's telling you, because that noise isn't going to help you to make long-term decisions. And it's important to adopt an attitude of resilience and flexibility, because we are going to have to adapt to some changes. That's sort of our watchword here at Yeske Buoy in the coming year and beyond, is that watchful waiting, being alert to the changes that are emerging, and especially being alert to those that are actually being implemented, and looking for the planning opportunities and reacting to them in real time. You know, to do otherwise, you risk overcommitting to one version of the future that can ultimately harm you if that one version of the future is not the one that manifests itself. So thank you for spending an hour with us. You know, as always, I enjoy talking about what's going on in the world, our take on it, and how we think you should interpret it and adapt to it. And although we're going just a few minutes over, if there are any questions, Yusuf, I'd love to see what they are and address those. And otherwise, I'll repeat that this will be recorded, is being recorded, and both the recording and the slides will be available to you. So Yusuf, could you send me a message so I know that I can see them? So new taxes, so we had a question about the impact of new taxes on imports. So some of the tax policy that's been proposed would increase the tax on imports and lower taxes on exports. One of the problems with that is that while it might, in the short run, depending on what the reaction of other trading partners was, it might in the short run help U.S. manufacturers and encourage manufacturing in the U.S. It also creates an implied tax on U.S. consumers. You know, if you tax imports at a higher rate, then U.S. consumers are going to pay more. A lot of what we consume here in the U.S. comes from other countries. Sometimes it's manufactured by U.S. companies that are then shipping it back into the U.S., but it fundamentally creates a tax on U.S. consumers. So the cost of living for consumers goes up. They have less money to spend on other things. So it can have a negative impact on consumption and the expansion of consumption, and it can have a negative impact on the quality of life for U.S. consumers. So again, thank you all for spending time with us. We look forward to your questions. Obviously, you can follow up by telephone and email on anything that occurs to you as you contemplate what we talked about today. And we look forward to talking to you again soon.